I talk to real estate investors every day, and everyone is always looking for ways to defer their taxes and optimize their portfolio. Today, we're going to talk about a lesser known strategy that's starting to become more popular with savvy real estate investors. What is a 721 exchange? Another term is an UPREIT. So what is a 721 exchange? So here's what I'm going to do. I'm going to build an org chart for you. So the top box is REIT. Underneath that box, we're going to put in there operating partnership. We're going to have a bunch of little boxes underneath, and we're going to call those boxes SPEs, or special purpose entities. So you notice the top box owns 100% of the middle box, and the middle box owns 100% of all the little boxes underneath. Well, where's all the real estate? All the real estate is located in all these little boxes called special purpose entities. So here's how a 721 exchange works. In order to defer your taxes through this exchange, you need to be an investor in the middle box. And the middle box is going to give you units, and that middle box is called the operating partnership. So the operating partnership is the direct owner of all the real estate underneath, and that's how you continue to defer your taxes through a 721, or another term is called UPREIT. Why would an investor want to do a 721 exchange? Most people who do exchanges are tired of the stressful 45 days and tired of trying to go out and find a piece of real estate, getting a broker, making sure it's under contract, and you got to do that over and over and over again. And we call that swap until you drop. So you got to do all that all the way up till you die. So why do all that if you're tired of doing all that, if you can do a 721 exchange? Because once you do a 721 exchange, meaning you're an investor in the operating partnership of this REIT, we call that hospice. That's where your 1031 exchange goes to die. And your kids or heirs or whoever you're leaving your money to still get that step up in basis and receive everything tax-free. What type of investor would benefit from a 721 exchange? Well, it's an investor that's really just looking for quality of life, not quantity. They have built up their net worth. They have a huge real estate portfolio, and they're kind of pretty tired of dealing with the active management of real estate, but definitely want to defer their taxes. This type of investor would benefit from a 721 exchange. What does liquidity look like? Liquidity is limited, and here's how it's limited. The REITs that people are going into, i.e. these 721 exchanges, are not traded REITs. And so liquidity is very limited. In order to liquidate your position, you have to convert your operating partnership units, i.e. the middle box, to REIT shares, which is the top box. Once that happens, the REIT has what's called a redemption feature, meaning if they have the cash, they will buy back your shares from you, and that's when you would obtain liquidity, but is a taxable event. What type of properties qualify for a 721 exchange? Well, most of the time it's institutional quality real estate, apartments or senior housing or self-storage. It's probably not going to be a single family residence that you're trying to divest yourself from. How can you participate in a 721 exchange? What I don't want you to come away with is thinking it's easy to take your apartment building and contribute it into a REIT, and now you've successfully done a 721 exchange. That's difficult to do. The reason why it's difficult to do is you're gonna have to go out and find a REIT that would be interested in obtaining your property. And that's a very tough thing to do. The most easiest way that you can participate in a 721 exchange is by using a Delaware statutory trust or a DST that has that option for you. If a Delaware statutory trust has a 721 exchange option, here's what's going to happen. That box to the left, or that DST box, is going to be contributed to this REIT and become a special purpose entity box. And for that, you will have units or become an investor in the operating partnership of this REIT. What are the potential risks of a 721? Well, number one, your 1031 exchange goes there to die. So if you want to continue to swap until you drop or continue to buy and sell, 721 exchanges are not for you. That's risk number one. Risk number two is the illiquidity of this REIT. Risk number three is the assets within this REIT. So I would encourage you to not only do the due diligence on the product that you're in, i.e. a DST that's going into this REIT, but also do your due diligence on the REIT you may be owning. Although a 721 exchange is something most people do not know about, they can be great for the right type of investor. We spent a lot of time building out an education center to equip real estate investors just like you. Check out our resource library to access everything you need when it comes to real estate investing. If you enjoyed this video, like, comment, and subscribe so you can never miss our latest content. Thank you for watching.